All right, everybody. Thanks for joining us today. We'll go ahead and get started. We're chatting today about getting you some help as a buyer in purchasing your home. We're going to chat about what are allowable seller credits. So, the seller helping you in purchasing your home, and then we're going to talk briefly about the loan limits and what we kind of preliminarily anticipate happening next year as it relates to conventional FHA, the Govy loans and whatnot. So with that, we'll bring on our co-host, Chase Hodgson. How you doing today, Chase?
I'm good, Jared. How are you today, sir?
Yeah, I'm good. I'm good. I'm a little bummed. We're changing of seasons, because now I got to shift, what I my my mountain bike for my snowboard, and but that's okay.
Yeah, first world problems, right?
Yeah, I say it, wah, right?
I'm, yeah, I'm so I love this. This is my favorite time of the year, man. I'm definitely a fall person.
Same. I love the changing the color of the trees. That's
Hmm.
that's awesome to see. I told you we were out in Wyoming last week, and it was
Yeah,
happening out there already, and it was just gorgeous. But
yeah, they're always a little bit ahead of us.
yeah, 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 for sure. Yeah, well, let's do a little housekeeping and get on to the conversation here. For you, those of you that I haven't met, my name is Jerod Lee. I'm the associate broker and team lead here at My Home Connection, also known as MHC Realty. We do have a sponsor for today. We've been developing the perfect home buying process for the better part of the last couple of decades. We've introduced a lot of reporting tools, a lot of podcast episodes. Um, we've now partnered with Chase in regards to getting you currently up to $500 on your appraisal and up to $500 on your home inspection at closing. We've got a no obligation consultation if you just want to chat about whether or not home buying makes sense right now or not. And then we really love to share real estate secrets, kind of give you some inside scoop into what's happening and what you need to look for and watch out for. So with that, we'll bring Chase back on. And I guess what we could start with is this whole seller concession thing. We've talked about it briefly in a few recent episodes, but really in COVID, sellers didn't have to contribute much, if anything, to help a buyer purchase the home because it was such a seller's market. We're finally to the point where we're able to, as agents, go ask sellers for our buyers, hey, can you help my buyer purchase your home? So just to reiterate, what are those things that sellers, and obviously we've kind of answered the question here, but how does that
Yeah.
work mechanically?
So yeah, it's been interesting because, like you said, during COVID, nobody was giving seller concessions. In fact, most people were paying well over asking price, right, just to get the home. And then we reverted, and I feel like we're like, I don't know, we might be a little late in this episode. I'm just saying because as
It's
the market gets healthier, I think we're going to see less and less of these around. But so the seller concession is basically, just a credit from the seller that can for the buyer to use in any way they want, right? That's the seller's mindset. But you can't always use it the way you want, right? Depending on the loan product that you're approved in, there's certain ways and certain amounts that you can actually use towards the loan. So we've had sometimes you have to get creative, but that's where again, you know, Jared, that relationship between the agent and lender is so important because you get them approved, and then you give let the agent know what program they're in and what kind of what we need to get the loan done and how much of a seller credit we can use. That's a conversation that should be had up front, right before the offers are made.
Yeah, and that's the dead horse we've been beating for quite a while, right? Is everybody jumps into the market, finds a home, and then wants to find financing. Where
Yeah,
if we had previously found out what the loan product is that is best suited for them and is most helpful to them, then we can go map the homes because not all homes qualify for all loan products. So
right.
we're quite often having to undo that a little bit. But that's a very good point. You were nice enough to send over. Let me pull it up here. Um, what those seller credits look like. Again, we weren't able to use them for a while because of COVID. We've seen that we've been able to use them for a time. As Chase mentioned, it we if our projections are right, it might not be long before we'll be able to use them again because we see the market strengthening up for a lot of
Yeah.
discussions we've talked about in previous episodes. But let's make an assumption that we're still able to get the buyer a credit, a seller credit. What Chase has provided for here, and you can speak to this, Chase. What are
Yeah.
the percentages?
Yeah. So Govy loans are pretty simple, right? FHA and VA loans, they have a set percentage. With FHA, you get 6% allowable max seller credit, and then with USDA, that's the one caveat, right? There's no limit on what they allow as far as a seller credit, but VA is 4%. But then so the market, I don't mean to stutter here, but the market kind of comes into play with the VA loan, because there's 4% of the established reasonable value in addition to the 2% max for closing costs, right? So the established reasonable value in that market kind of comes into play on the VA side, but typically it's just a point of fact that FHA and VA, you can go higher than conventional, right? A lot of times when you get into conventional loans, it's you're putting a minimum down, like a minimum or 10%, right? And so if you're putting less than 10% down, you're capped out at 3% of a seller credit. If you go anywhere from 10 to 25%, as the chart says there, you're at 6%, and then 25% you're allowed up to 9%. 25% and above, you're allowed up to 9% of a seller credit. So conventional gets kind of confusing, but the majority of the loans that we see are actually under 10%, and so you're really capped at that 3%, which can be like in the times that we've been in, right, Jerod? You've seen, we've seen $15,000, $20,000, $25,000 seller credits from builders, and you just flat out can't use it, and everybody gets mad at the lender. But we hate these guidelines too.
Yeah, well, I think that's a good point to know is that you're going to see these promotions from some of these lenders, and it's important to know whether you can actually use them or not. It's like, oh,
Yeah.
$40,000. Like, well, that's all well and good, but if you're capped because of the loan type you have, it's not really $40,000. Not that the builder wouldn't give it to you, but you're just not qualified to use it.
Yeah. Yeah, so it's really it becomes pretty situational, and knowing know when you can use, and like we talked about, just preparing for it in advance, because that's also going to help you, right, and strengthen, like, the knowledge helps you to know what you can fight for your clients as well. It gives you that foot up in your negotiating ability, right?
Yeah. Yeah. Well, and I think, maybe I should have put this at the front end of the conversation, but it's important to know if people feel discouraged that they're unable to buy, if they're not aware of seller credits, it can be discouraging. All of a sudden, it's like, okay, now, your the big bulk of your out of pocket expenses are going to be your down, right? Because that's not something that the seller can help you with.
No.
But the downs, talked about this in prior episodes. Most downs on most loans are far less than the majority of people think.
Yes.
It's not
Yeah.
20%, which is kind of the normal go-to mindset.
Yeah. Yeah, and depending on your income limit, right? Like, again, I can't say how blessed we are to have a partner like Idaho Housing here in our state, but most states have some sort of bond agency where they give down payment assistance and things. But I know for us, you can get in with as little as 0.5% down in Idaho. So depending on your income limits in the program. And so it's, having that knowledge and that education and knowing what you can do, but then, like, it just, they add layers, right? And it gets more difficult. So, as we talk about these the limits to the amount of seller credit that you can have, then you have to look at the underpinning. Okay, well, so now I've got them, right? I know I can max out my seller credit, but now do I have enough closing costs that they allow you to pay with that seller credit?
Right.
Use up the funds, right? So there's a bunch of different layers there, because to go down the list, appraisal fees and inspection fees and origination and title fees, title search fees, repair costs, property taxes, prepaying taxes. You can use those, recording fees, and then buying down your rate, what they call discount points. Like, that's the probably the mass of what you can use seller credits for. There are other things, but it's limited in how you use it too. So knowing, again, I like you said, talking about beating a dead horse, but going back to, okay, knowing these are what our closing costs, or a good estimate of what our closing costs will be. This is how much we can use as a seller credit. How do we align those two? Okay, here, now go make your offer, right? Like that's kind
Yeah.
of the step there.
Yeah, and I think a critical point is, all three of us need to be involved: your agent, your lender, and then the borrower, the buyer, to determine all of these things. What's the loan product? Then go find homes that do map to that loan product. And then, by the way, I can dig into which of those homes are likely homeowners are likely to provide some or an aggressive seller credit in the home purchase process to
Right.
pull all this together. And if you just go find a home, it might not map to any of that. And anyway.
This is like, like, I don't know, the NAR thing comes to mind again, because, realtors can come under fire, with their commissions being brought to the forefront here. But at the same time, like, you you don't just you're not going to take your car to the guy that does HVAC, right? Like, there's experts in each industry, and this is why, because there's layers to everything that we do that buyers and sellers don't know about, and they don't have to know about, because the majority of people are going to buy and sell 2 or 3 houses max in their lifetime,
Yeah.
right? And so understanding why this is kind of the underlying cause of why it's so important to have professionals on your side.
Yeah, yeah, absolutely. Well, the one that you commented on that I do want to drill down in is because it's very common now, right? The perception is interest rates are high. Okay, they're higher, right, than they
Hmm.
were during COVID. Doesn't necessarily mean they're high. We've seen easily double-digit interest rates over time, but historical
Yep.
averages in the sevens. So they're higher. How do we help adjust that? How do we make a home more affordable? Well, the rate buy down, the discount points that a seller could give you to buy the home down at a high level. Can you describe how helpful that can be to have a seller? I'll pull up these percentages again. Just kind of pick one, like a 3%er. How would you position a buyer to get some of that allowable seller credit to buy down the rate, and roughly what does that mean to them?
Yeah, so there's a couple different ways that you can approach it, and depending on, and each person's situation, like, that's, I can't, like, harp on that enough,
Right.
is your personal situation, and what your finances and everything look like are really important in helping decide that.
Hmm.
But there's a couple ways you can approach it. One is just straight discount points and buying your interest rate down, right? So, a $15,000 or $20,000 seller credit in today's market is probably going to get you anywhere from 3/4 to a point and a half, depending on the program. Uh, so 3/4 to a point and a half
That's
lower.
significant.
It is.
That's a
It's very
major
significant.
adjustment in your payment.
Yeah, yeah. Depending. I mean, minimum you're probably saving $300 a month there, right? Depending on the price of the house, it could be considerably more than that, right? The loan amount. So that can be very effective. I'm kind of bullish right now on, and I haven't been. Um, the beginning of this year I wasn't so much, but on temporary buy downs, right? Because the interest rates are trending down and have been, so significantly. We're still seeing some volatility, obviously, but if you can use that to do a temporary buy down right now and start out with a 3% interest rate the first year, a 4% the second year, so a temporary buy down's similar. You'd use the seller credit, and then the way that they work is that credit goes into basically like an escrow account.
Hmm.
So payment on your home doesn't actually change. Your payment will be, so say it's $1,000 a month, right? But then we're doing the temporary buy down, and the difference in what the payment would be with the rate that you locked at, like say it's 5%,
Hmm.
versus what the payment would be at 3%, that's pulled from that escrow account each month to make up the difference.
Hmm.
Okay. And so all is that you're paying what would be a 3% right mortgage every month, right?
Yeah.
So the first year 3%, the second year 4%. On a 3-2-1 buy down, it's just like that, and then the third year it goes to what the lock rate is.
Yeah. So the three,
Um,
two, one. Just for folks that are listening to clarify, a 3-2-1 is a 3-year buy down. You're buying the first year down the most. You're buying
yeah,
the second year down a little less, and then you're buying the third year down a little
you're
less.
down.
You're getting closer to that more long term
Mhm.
note. That first year, that 3 buy down can be very significant, multiple
Yeah.
points, multiple percentages,
Yep.
alleviates
Yeah.
a lot.
Yeah. I mean, you're talking about a ton of savings, a ton of savings, right?
Yeah,
So you're if you're able to do that for a couple years, right? So if you're 3% lower the first year, 2% the next year, the way interest rates are trending, you're more than likely going to be able to within the next year or two, refinance and lock at a rate that is more reasonable than what you're seeing today, and then any money that's left over in that account then gets applied to the principal, right? So
that's
you
what I
don't
was.
lose the credit, right? Like
Yeah,
that's the great thing about them. So it's not something that you would do in an increasing interest rate environment, but where we're on the downward slope, like if
yeah,
you can just buy some time, right? Just buy some time using the seller's money,
yeah,
and save you on a monthly payment. I think it's a good situation right now.
yeah. And that's where I was hoping you were going with that. Is if we're anticipating rates to go down, um, maybe a permanent rate buy down isn't the best solution for you. It's a
Right.
temporary, and then once it gets to the point where you're like, okay, this is what I'm in a long term position. I'm going to stay in this house, for a decade, to whatever it might be.
Yep.
Now to permanently lock in my rate at an attractive, percentage rate, then that makes sense. Again, you wouldn't do that in an increasing.
No, temporaries are not great unless it's like unless you feel like the market's a short-lived increase or something like that. But it's also hard to guess. We want pretty good downward trend lines and pretty good data showing that rates should continue down, which is what we're seeing now, right?
Hmm.
Which we've talked about ad nauseum
Yeah.
on here, so I'm not going to go into it.
Yeah. Yeah. Well, let's talk a little bit about what we think. We're coming up on the latter part of 2024 election year, and we've talked at length about, post election, you know, just traditionally things have strengthened up, values have come up. We're expecting demand to come back online because interest rates are dropping. So, I would say, if you're coming to us, the latter part of 2024, early 2025, I think there might be some sellers out there that are open to providing, a seller credit. But by spring, we really expect demand to come on hard, and
Yeah.
interest rates to be down quite considerably from where they've been.
Yeah, we're still dealing with, and I mean, you know this better than I do. We're still dealing with a low inventory environment, and it's just again basic economics, right? Like
Yeah.
you have good demand and low inventory, then prices are going to continue up. And as we shift back to that higher demand market, and sellers are going to people are going to be competing for the properties, and sellers are going to be able to raise their prices, and therefore not have to give concessions. And I know a lot of the builders in the valley are holding their prices where they're at and doing the seller concessions so they don't have to drop the sales price, right?
Right.
And so because they want to maintain that price level, and so you'll see those concessions going away because now they can get that price without having any concessions involved. So it's I think yeah, I really do think by the first of the year, it's probably going to be over for
Yeah.
our great seller concessions. I mean, there's always opportunity. You can always negotiate.
Yeah.
But as anybody knows, if there's only one truck left on the car lot and you got 30 people that want a truck, you know what I mean? Like,
Not much room for
who's going to
negotiating.
win it? Yeah.
Yeah, yeah. Well, you just brought up a good point, and then my mind went off in another direction. Um, so I think I'm embarrassed and I'm going to forget what it was, but certainly the timing of when you can get seller credits, what you can use the seller credits for, is important, and then any cap associated to the seller credit. That's kind of how you want to approach the market. Know what they are, know how to use them, and know if you're eligible to use everything you're asking for.
Yeah, absolutely. And the last thing that I would say on that, and we can go into what we expect for next year, but the last thing I would say on that is that your finances really are the biggest deciding factor, right? I went to listen to a gentleman speak yesterday that owns billions in real estate, like
Mm,
just really buys and acquires at a high level, both residential, commercial, and owns a building company as well. And it real estate is one of those things that always goes up over time, right? It's not something you should think about just buying and getting out of really quick to try to make money.
mm,
The value in your real estate comes over time, and the increase in equity um, over years and years. And so your finances and what you can afford, that's really what's going to
yeah,
determine when it's right for you to buy.
yeah,
But waiting when you know you can afford it, I promise that the opportunity costs are going to affect you, right? Just like we're
yeah,
talking about,
yeah,
like seller credits moving, going away, lessening. Like right now, if you can afford it in your budget and it's the right move for you and your family,
yeah,
don't wait.
yeah. Especially like you said, especially if you get a seller that's helping you, willing to help you
Yes,
make that
yeah. As
happen.
these go away, like that's just opportunity lost, right?
Yeah, yeah, absolutely. Well, the other topic that we wanted to chat about today for the listeners is loan limit changes coming up next year. They're not quite set in stone, but we've got some pretty good idea of what that's going to look like.
Yeah, there's so we have like they don't come out to the first of the year, but it's been kind of a trend in lending to where you have early access to them, and so everybody kind of does figures out what they think they're going to be. Last year they were kind of spot on. This year so we already have for conventional loan limits, and that's the only one that I have early access to currently. Uh, we're at 802. Oh, do you have that? Do you have that graphic
Oh, the one I
or
just showed, was it on there?
uh,
This one here?
no, it's not on that one. I emailed you another one. Sorry.
Oh, sorry, yeah, I didn't pull that up.
So what we're approved for is 802,650 on a single unit, a million 27,750 on 2 units, a million 242,250 on 3 units, and then 1.5 and some change on 4 units, right, for conventional loans. Because that's something else that you need to realize is you can buy multifamily up to single family residential is considered 1 to 4 units, right? So you can buy up to a fourplex with a conventional loan that's insured by Fannie and Freddie.
Yeah, no, it's important for those that don't know, right? These loan limit adjustments sometimes lag as it relates to the value in any one particular market. So it's always this, hey, I want to buy in the Boise area market, but the values have skyrocketed and the loan limits haven't kept up.
Yeah,
You've seen some years are just like they don't even it's just painful. But I think in the last couple of years they've been pretty good with keeping those
yeah,
loan limit adjustments in line with where the market's going.
yeah. Because I mean, the last couple of years have been good because they were pretty seriously behind before that.
Mm-hmm.
I think you can remember that, but they're like, so we're going from on a conventional single family purchase, you're going from 766 to 802. That's a pretty massive jump.
Mm-hmm.
I think over year right now we're just right close to 5% on appreciation, and so that's kind of right in line with what we expect. And to kind of clarify, um, the reason that this is important is because as houses become more expensive, this gives you the option of buying with a conventional or government loan still at these higher prices. If they don't move these loan limits, then you're looking at your only options jumbo or non QM. You got your typical conventional, and when I mean just the conventional style way that we do loans in mortgages: FHA, USDA, VA, and then conventional backed by Fannie Freddie. If you get over these loan limits, then you're in the non QM world, which has jumbo loans typically have stricter they have stricter underwriting guidelines. Historically, even though it's not the case right now, but historically they've always had considerably higher interest rates,
More expensive.
um,
Yeah.
and then larger down payment requirements, right? So you're not getting in a jumbo loan with 3% down.
Yeah.
And so by moving these loan limits, it makes these homes more accessible to the general public.
Yeah. Yeah. So all positive stuff. We seem to be keeping on track of where the market's going, the values are going, where our loan limits are. So that's all encouraging news. And just to kind of feed off of the other comment that you just made about where our values are going. Everybody in our, I don't know about everybody, but most people in our market expect that our values are going to continue to go up.
Yeah.
Probably in the single digit mark, but they're going to be going up based upon what we see in inventory and what we see with oncoming demand, with interest rates dropping, and kind of how all that's gonna
Yeah.
gonna play out. Just to give kind of a foreshadowing of next year, all based upon the fundamentals, right? We're not making stuff up here, right? It's all things that have always proven true, right? Supply demand ratios,
Yes.
all
Yeah.
that.
It's just basic economics, right? Like we just don't have the supply, and I think we spoke specifically about this before,
Yeah,
but the current cross section of buyers, there's literally 10 million more of them than this country's ever seen. So we've never had the inventory, right? It's not like, oh, we've got a few more and it's increased, but we've never had the amount of inventory that we need. And on top of that, you have a bunch of people locked into 2% and 3% loans, but back when they were that low, which nobody expected. So they're not as eager to give that up, right? And either upgrade or downgrade as they normally would be. So you have less existing homes coming on the market as well.
yeah,
And so it's really putting kind of a pinch on our real estate market. And ultimately that's what's driven prices up.
yeah,
So once they stabilize that, then we should see pricing stabilize. But for the foreseeable future, like that's why I'm definitely more aggressive about, if you can afford a home, buy it now, because in the foreseeable future it's just going to continue up.
yeah, yeah, absolutely.
But also from the investment side, right? Like from the investment side, like and it's kind of what I love to focus on is that I think the first step in building real wealth is owning a primary residence, and there's people that have done it a different way, right? But for the vast majority of public of the public, you increase your wealth considerably over the first 5 years of owning a home
Yeah,
in equity alone. And so, you know, knowing that real estate is more than likely going to go up for the foreseeable future is another reason to get in now, because
yeah,
you can start that forced savings account right away.
yeah, yeah. And we've talked ad nauseum about forced savings account, but I think it's just we can't understate
Right.
uh, well, I think it's overstate the importance of that forced savings. None of us are really good at setting. Not none of us. Most of us aren't super good at just setting money aside. But when you're going to make your house payment, and you're likely going to appreciate in value, i.e.,
Hmm.
generate create wealth. So
Yeah. And that's what it is. It's really all just about changing habits for most of us, and that's the reason that there's such a separation between the wealthy and the rest of us, is because you have to make the decision to take the next step. You have to be diligent, and you have to be disciplined in order to do that. But I'm telling you, like I'm of the belief, and I'm yeah, that most of the time, if you back a human being into a corner, they're going to fight their way out.
yeah,
And so I'm all about taking that risk, putting yourself out there, because 99% of the time you're going to fight your way out of that corner and end up better on the other side.
that's right. That's right. Yeah, well, I think that's a great way to wrap it up. I think we can actually be pretty proud of ourselves. We're keeping it under the 30-minute mark this week,
Yeah.
so woo, we did it finally.
Wow, that's the first.
That's right. But I think we covered a lot of ground. I think we covered a lot of great territory. For those that have questions about anything and everything that we talked about today, feel free to reach out. We'd love to help. Take advantage of that free, no obligation consultation, and we'll just talk about all this and see if this is right for you. Because Chase is absolutely right. This is a personal decision. This is a personal circumstance, and we need to make sure that everything works just right for you. And we're going to shoot you straight, just as if we were helping our kids or family, friends purchase a home, and we'd love to help.
Absolutely.
Awesome. Well, thanks again for joining us today, Chase, and we'll just sign up by wishing everybody a blessed one. Thanks.